I'll do the opening hook. Hey, welcome to the Capital Conversations podcast, where today we're going to unlock the art and science of turning ideas into investments. I'm your host, Erik Nelson, and along with my co-host, Karen Rands, we're diving into a topic that makes or breaks a startup's future: crafting an appealing and a successful investor presentation. Whether you are a founder chasing angel investors, or an investment bank or venture capital firm, or even an investor looking to spot the next home run investment, this is your playbook for what makes a pitch deck shine. From nailing the problem to solution to hook to showcasing traction that screams invest in us, we'll break down the essentials that grab the attention and open wallets. So grab your coffee, get your notebook, and get ready, because let's discover how to tell a story that will turn skeptics into stakeholders. And with that, here is
So am I supposed to do the disclaimer now?
Yeah, you read the disclaimer.
I gotta go pull it up. Okay.
You want me to do it?
Yeah, you do it. I don't.
The information provided in this podcast is for educational and informational purposes only, and is not intended as general financial advice. The views and the opinions expressed by the host and their guests are their own and do not necessarily reflect the official policy or position of any financial institution or organization. You should always consult with a qualified financial advisor or conduct your own research before making any investment decisions. The content of this podcast may include forward-looking statements that are subject to risk and uncertainties. We do not guarantee the accuracy, the completeness, or the usefulness of any information discussed. By listening to this podcast, you agree not to hold the host, guests, or any affiliated parties liable for any losses or damages that may arise from your reliance on the information provided.
There we go.
All right, so today we are going to take a look at what are the essential elements of a successful investor presentation. And
Okay.
we're going to do this because we've seen so many bad presentations lately. And I know there's a lot of really good companies out there that are living and dying by the success of these presentations. So Karen's going to walk us through this today, because she is one of the best I've ever met at preparing companies and helping them get a presentation that will get them some capital raised. So with that, let's start with Karen.
All right. So I want to say that let's just talk about reason why there are bad presentations. Two main reasons why. Number one, well, three reasons. Number one is entrepreneurs just really are not, it's a beauty contest. So here's the thing. When it comes to raising capital with investors are looking at a lot of different presentations, and they are trying to decide in the first 90 seconds if they're going to spend 6 minutes listening to this, and in that 6 minutes, are they going to spend 90 minutes asking questions or an hour follow-up afterwards. So the number one thing is that a presentation, a pitch deck, or an investor presentation isn't to close on capital. It's to get to the next meeting. The second thing is that entrepreneurs oftentimes confuse a sales presentation for their customers with an investor presentation. You are not selling your product, you're selling your company. So you got to think about the focus of that. And then what are the questions that you need to answer in that will make that investor want to ask more questions, right? So what do you need to cover? There's a consistent formula that we're going to talk about that has to be in the presentation, but it all comes down to why an investor cares. Why does an investor care about what you're doing? And Erik, what do you think is the number one question that why an investor cares?
That's a good question. I think the number one reason why an investor cares is because they think they can make money with this investment.
Ding, 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 and the prize goes to you. That's exactly right. They want to know, are you going to make them more money, and are they confident of what you're going to make, risk versus reward versus the other presentations they're seeing? And here's the thing about the reason why a presentation, we got into a habit over time where, because investors that are free with their capital. So like West Coast investors tend to put a little money in a lot of companies. And that's where like the whole SAFE thing came from. That was, a simple agreement for future equity because they didn't want to get bogged down in the details. So for the bubble of Silicon Valley, entrepreneurs started to think and believe that a presentation, a pitch deck, could be their business plan, could be their everything, and maybe an executive summary. And it's not. The
No.
numbers tell the story. The business plan is the narrative that explains and supports the numbers, and the pitch deck is a visual representation of all of that.
Yes, that is
So,
super important. And as I tell people all the time, an investor presentation is not a business plan, and Silicon Valley is in its own unique little bubble, and it doesn't work outside of Silicon.
yeah. Everywhere else in the US, they want to see the meat on the bones and see how you're going to do it and what are you going to do. They're much more conservative. And key point, because we talk about raising capital on these crowdfunding platforms, Reg A Plus, for example, it's a whole nother level of preparation and detail that you have to have, because when you're doing anything that's online, see, the value of traditional angel pitches is that you're sitting eyeball to eyeball with somebody across a table usually, and even when you get to a point with VCs or anything like that, you're in a boardroom, so they can interrupt and ask questions. You've already gone through some kind of qualifier to get there, all that kind of stuff. Whereas when you're online, you have to, one, get to the point quickly. Two, you've got to be able to really validate that, because chances are they will never meet you eyeball to eyeball. They'll see a webinar just like a public company. It's got to stand on its own, all of it. The pitch deck is sort of like the icing on the cake of everything else that has to be there in order, and it has to convey the no trust buy, the trust factor, because it's, it's all why an investor cares. So that's that. That's the top level. Then we can get into everything else about what goes into a pitch deck. But that's why it's so important, and why we see, I swear, Erik, when I was running that angel group and you would come and you'd see these things, I mean, we would review, just like every angel group, they typically will look at least 50 presentations in a month in order to find the 5 that get to the short list and the 3 that actually get to present. And it's not always to say those companies aren't good. They might have a good business model. They might have a good strategy. They might have stuff, but they don't convey it well in their pitch deck. And they get eliminated without ever even getting an opportunity to explain themselves.
Well, yeah, when I've reviewed, investor presentations and pitch decks, when I've been considering mergers, potential mergers for my companies, sometimes you look at that and you're like, I don't really know what the company does or how they make money.
Yeah.
And you're like, and you go on to the next one. There's a limited amount of time to go back and ask questions, and these pitch decks have to solve that problem. It's like an extended version of the proverbial 30-second elevator pitch.
Yeah, right. I remember one, and so typical presentation is about 10 minutes long. The one that you would do at a like in a normal angel investor kind of a thing. But almost all pitch events do 6-minute presentations. And when I first took over the Network of Business Angels and Investors, and I remember I was at an event out at the Ritz or whatever that's out there and going towards Covington, the resort out there, the subdivision
On the lake.
Yeah. Reynolds Plantation. No, what is that? Yeah, it's Reynolds. Anyway, yeah. And it was a venture capital conference, and there was a bunch of, of the venture capital that was around back then. So this is, 25 years ago. And Steve Fleming, I remember him. He had just taken over ATDC and was running that. And Kathy from Nora Mosley was there. It was like all these were standing around this circle, and they were doing 6-minute presentations. And at the time, I was contemplating on going from a 9-minute to a 20-minute presentation at our events, because I thought, how in the world can a company, convey their business proposition and everything about them in 20 minutes? And a lot of times entrepreneurs would ask me that. And I was like, I know, it's so hard, all that kind of stuff. You really want to be able to go into all this detail. And that was when I was informed by people that had been making investments and making these decisions long before me, that First of all, you're not closing any capital in that, so you're not going to be able to answer all the questions in 20 minutes anyway. And two, I don't want to spend 20 minutes. And I said, like 6 minutes, how can you do 6 minutes? And Steve Fleming said, I decide in the first 90 seconds whether I'm going to pay attention in 6 minutes. And you can tell that when people are out at the pitch event. If you got a lot of people looking down at their phones, they turned you off, right? You got to grab their attention. That's why the executive summary or the why an investor care, the elevator pitch, is part of the very first thing you say on your intro chart, right? And then you go through these things and your 6 minutes, they decide if they're going to spend that 90 minutes with you to follow up on that, to ask questions. He says, I can get to a no really easy in 5 minutes. But to get to a yes takes a lot more time, and I have to be convinced that it's worth my time, which time is money to investors. And so that's it's really important to be able to put that together. And when you see good presentations, I sit in some of these pitch events. Ty has gotten really good at doing their pitch events and getting people, but I've sit at some of these things, and it is amazing amount of information that well prepared entrepreneurs, the ATDC company went to that graduation, they convey. It's like it doesn't even seem like it's been 6 minutes because they've hit all the top points.
And they don't bore you.
And they do not bore you,
right?
So how do you want me to, let's see, can I do the presentation? Let's see, can I show my chart here?
Yeah, you want to see the anatomy of the pitch?
Yeah, pull that chart up.
All right, let me do this. I'm going to share.
In fact, I'm doing a business plan pitch competition judge for the Blockchain Investors Group on Thursday.
I would be there, but I'm on my way to Iowa for a wedding.
So zoom into this a little bit.
All right, let me see what I can do here to do what I can to zoom in on this. Bear with me a second.
There we go.
There we go.
Okay.
How's that?
Yeah. So I just mentioned the elevator pitch, right? So that's your first 30 to 60 seconds. You know, the old adage when I was in IBM was tell them what you're going to tell them and then tell them and then tell them what you told them, right? So that's where you recap at the end. So you're going to talk about, the main thing you're talking about is the problem you're solving, some credibility as to why you are the one to solve it. Either whether it's personal story, your aha moment, you figured out this was a problem, you figured out this is why. And so you want to get their attention so they go, oh, okay. Particularly if they've not seen an executive summary in advance. Sometimes, you know, these organizations will give an executive summary or a summary profile sheet, right? And so then you go in, you expand, and you get into the problem, the solution, the market size. So what I have here is, you know, where it normally is going to take, like it shows 2.5 minutes. If you're having to cut it down, then this is where you're going to spend, instead of 2.5 minutes, you're going to summarize this in 1 or 2 charts instead of 3 charts that are going to be more like 90 seconds as you start to, because this is the main reason why you have to really do a good job of covering this, is because investors are calculating in their brain, particularly sophisticated accredited investors, how is it a big enough opportunity that if you get whatever percentage of it, you can make enough money that they can get the multiple on their investment that they're going to require in order to make the investment. And seasoned investors know that you're not building a 50 million company that's poised for acquisition or a $100 million company that's poised for a public offering by just raising $2 million, that you're going to have to raise more money. So you've got to have a big enough of a market opportunity so that says that when you raise $10 million, is there still enough return on investment for all those investors and that first initial group that got squished down a little bit, that their share, they're no longer 10% of the company or something like that, or 30% of the company. They're now more like 15% of the company from that initial investment if they didn't invest more, but their shares went from being 50 cents or $1 a share in that initial round to $5 a share because you grew in warranted value in addition to the capital you took on, that you're going to be able to make that kind of exit. So this part, even though you're not saying that, you're saying that by saying what is the problem you're solving, how are you uniquely solving it, and how big is the market opportunity to solve that problem, right? I mean, Erik, you have seen this probably more than anybody, where a company has gone from private to conveying this in a public. And even when they're raising, like we talk about, when they have to go back out to the investment bankers to see if they're going to be able to sell their offering and attract a market maker, right? It's an even bigger story then. So, like, where have you seen in your experience in seeing early stage startups versus, like you're just talking about, you probably can't, I'm not sure if you can say your public company that you're just like we're talking about before we got on the thing, but even any of these ones that you rang the bell or you help them when they're doing a SPAC filing, whatever, where does the message, how much does that message change in that first key component of problem solution market size?
I would say that, in the, you look at the first couple points here on your chart, the introduction through the traction and the market size, that first half of that presentation doesn't change a lot, because that's what creates the excitement. It gets the hook in, gets the people interested. The later half of it, I think, can change a lot over time. But really what you're doing is when you're going out there and on these presentations, this is the existing opportunity. This is how we see additional opportunities coming in, and this is how we grow a business. And investors want to buy a business that grows, and they want to see that, they want to see how you're going to expand into multiple markets as well.
Yeah.
I've had a lot of go ahead.
No, but that's where. So the difference here, and this is where traction comes in. If you see that little arrow sticking out there for traction, very early companies, you're not going to have a lot of traction. It's going to be more market validation, customer surveys. You've got a product that you've gotten some feedback, but then as you become a later stage company, or a company that's a Reg A plus kind of a company that is filing financials with the SEC, or some of these things that we've talked about in the ways that people go public and raise capital that way, you're going to have a lot of proof of what you've done. And if you're raising capital for growing, like in the Reg A plus examples, they might have plateaued. Now they want to bring out a new product. They want to do an acquisition. What is that going to look like from where they are now, and how are they scaling? So this becomes part of the scale conversation. So it takes on a different tenor. It takes on different evidence of what they're going to do. One is forward. They're all going to be forward looking. But one of them proves that you've done in the past that you have the ability to do it again, do it more of it in the future.
That's right. Just like a software team developing constantly new products to show their competence.
Right.
And their ability to bring multiple things to the market.
And then you get into your customers. So it's who's your target customer? How are you going to identify those customers? That gets into your business model and your sales cycle. So it's very specific to who those customers are. If you've got customers, how are you going to get more customers? How are you compounding, upselling, cross-selling, all that kind of stuff? If you're expanding into new markets, how are you going to leverage those new markets based on what you have? All of that. Business model and sales cycle. So startups and early stage companies are they're theoretical, but they can rely on all of the businesses that, this is one of those things that I get into hard conversations with entrepreneurs on and founders a lot of times, because and this is where an investor will go, okay, he doesn't really know what he's doing, because they don't understand that every type of company, whether it's a consumer products, whether it's a software service, SaaS product, whether it's, whatever it is, it's some kind of, industrial thing, whatever it is, it has a different business model. And business models sometimes are seasonal even. And you can tell that they don't know what they're doing when they don't specifically talk about a sales cycle that's custom to them. They just do a percentage of the revenue, or they have this broad market that they're going to service, and you can't set a marketing strategy or a sales strategy that's to a broad market. It has to be specialized in this competitive world that we're in, and this noisy world where you're trying to break through all the noise to get to your customer, that you're solving a problem they have. How do they find you? How do they know that? Can they make a decision right now? Do they have to have customer references? Do they have to have a trial? Do they have to test it for 3 months? What is it? What is the sales cycle that's unique to that company and to that customer? And when early stage companies a lot of times take this for granted, that they can just throw what ifs out there. And they can't. It's hard raising capital. There are so few investors compared to the amount of companies that are raising capital. This becomes such a critical part of it that you have to have that. And I think, tell me, when companies are raising capital or getting ready to raise capital from investment banks and from these market makers that are going to take it to an elite group of their broker clients, how much more important is this area that says that they're going to use this capital to do what? That's going to grow their market cap. It seems like easier to go from 50 cents a share to $5 a share, but when they're already at $5, $10 a share, they can't go $20 a share. It's much harder as a public company, but it's a big deal if a public stock even goes up 5%, right? Or 10% on it. So talk about that and how that message is either more important or is conveyed in a different way.
No, it becomes more important because when you're working with investment banks, what you're doing is you pitch to the institutional investors, and you have to present your presentation on the company to their biggest and their best clients. But a lot of what you spend time doing is you're presenting your company and giving your presentation to the sales force, to the brokers, to the bankers. And you're giving it to really sophisticated people who understand this, or they understand a lot about business. And then your job is to educate them on the parts that they don't understand, and to educate these people so that they can answer the questions that their clients ask them. So when their client goes, how long does it take to sell this software product?
Right.
There can be a built-in answer. If you have a software company, for example, that partners with a pre-existing business to sell to their customers, you could have a really short sales cycle. But if you're selling a software product to other businesses where they're the end buyer, it might take you 6 months to a year to close a sale. And that happens. These are different things, and people need to understand this. And then this is also how they will test your financial model down the road, and see if these assumptions make sense.
And in this area here too is where you might have, between the markets part and into this area, you're going to have to convey your key performance indicators. Okay, yep. It's not listed on this chart, but it becomes an element. And as the more sophisticated your investors are, the more they want to know that you know this. And so, for example, if you are a manufacturing of whatever it is, okay, there is on your cost structure, there's going to be a fixed cost of materials and the age, and then the stuff that gets in, it gets built. When does it come into your possession? Is it, when does that financial responsibility transfer? Or is it going straight from the manufacturing to a retailer or a distribution center? Those becomes part of your financial model that you don't realize your revenue. And when do you realize your revenue? If you're selling through a retail channel, if you're selling online, you get your revenue right away. If you're selling through a retail channel, sometimes, for example, if you're selling through a big box retailer, they don't pay you until 30 days after it's gone through their cash register. So how long do you have to float that? And if as a mature company that's raising capital to grow, one of the things that you have to be really clear on, and this is when we advise companies you've got to know those numbers. You've got to know, and so you can measure, because that's the health of the company. Sometimes the profit is like a spigot that just, like, it doesn't get realized, it doesn't get retained, because they don't know that they're hemorrhaging money on their cost of money, because they haven't tightened up their manufacturing process from when they get it and when they collect. And do they have problems with collecting? I was talking, oh my God, I was walking, like, and my friend of mine, she's in the billing for a major, I think they're a public company, they're international. They manufacture lighting. Let's just say that, right?
Okay.
They have offices here. They have offices in Mexico and a plant in Mexico. She's U.S. based, but manages that. And they have like these terms where a lot of companies will have terms that say, if you pay by this date, you get 3% off or something, right? Because they want you to pay within the 30 days. Then they don't get charged the money. It's all within that sales cycle. And it turned out that they did not have an automated system for automatically timing that and sending this out. It was a human error. And they had a person, and because of HR laws, they couldn't just fire this other person. It was her employee that was changing the dates so that they could still get their credit, and she didn't get dinged for not collecting it.
Well,
And then when they finally put her on a plan and they ended up having to write off all this money at the end of the year because it had never been properly billed or collected, and those customers didn't even know how to pay the money. It was like, I couldn't believe that there was this big company with that kind of problem internally that had not, you know what I mean? So investors want to know that you have what is your collection cycle? When do you bill for that? When does the responsibility of that bill? Now, you're not going to have that in a presentation. It's not going to be something that you're going to have. But if you know that that's important to your audience, then you're going to say something like, oh, we know how important, like when we get into our barriers to entry, right? What is our business model? What is our key differentiators makes us a good investment choice is that we know our numbers. We know when we can bill for a product, we're tracking it. We have this state-of-the-art system. We use AI to do this, that, or the other thing. So we are going to be more profitable than our competitors because we have this insight into our business model. It's that kind of stuff. Customer onboarding, all those things become part of your IP protection, because it might be internal processes that you have, plus whatever your patents are. These are all part of you being better than your competition. And then if you have these joint venture partners that are helping you solve this, like you mentioned, Erik, you're selling through partner channels. Do you know, because sometimes people will just license their stuff, but they got no controls over what is that IP, that partner doing to actually sell it. They don't have teeth in their agreements that hold them accountable for selling it. All of that becomes important when you're a startup saying, you're gonna do this. These are what you've done with these partners. This is why it's not just something that anybody could sign. And this is what a public company or a company about to want to go public needs to be able to convey to compete against all the other companies raising capital. You're competing, you're showing your competition, but you're also showing how you're better investment because you have this kind of information. What do you think about that? All of that?
I think that brings up a lot of excellent points. When I've built out financial models for clients, you will find that sometimes your payables, you're paying your payables a lot faster than you're collecting your receivables. And you're financing that growth, that expansion of that balance sheet, either with internally generated cash, or you have to go borrow some money, some short-term money from a bank, and you have to have the right lending partner for that. We're getting close to where we call the management.
Yeah.
The management there. As a good friend of mine who's backed about 40 startups has said, it's the management, it's the jockey, not the horse. That's really what it is. And if you have a good management team that can successfully sell, create new products and sell them, they will continue to create and sell new products. And if they can run it, cover all the bases, they're probably going to continue to do so.
Yeah, and it becomes really important if you're a company that has plateaued, you raised your angel round, thought that was going to be enough, didn't really anticipate what was going to happen in the marketplace. Maybe you got dinged up by COVID, maybe whatever it was. You know what I mean? There's been economic down. Now we're dealing with tariffs that are disrupting businesses, and so there's outside elements. But if you have a good management team knows how to navigate that, amplify that. Talk about how your management team has overcome that. We have a client that I modified his presentation because the fact they did survive. They have not scaled like they thought they would, but they did very, very good business pivoting during COVID in the food sector, amplified as a strength. And that, to me, says as you're raising capital right now, getting ready to go into this uncertainty, this management team has proven that they know how to manage to uncertainty and be able to succeed in it. And that becomes a real strength. So when you talk about some of that in management, and if you have a gap, if you know that you have somebody that was kind of weak, or you don't have the level of expertise that you need for this area, because maybe the person kind of grew up and they really shouldn't be a VP, they just need to be a manager. Maybe they don't have the expertise. Maybe they don't have the desire. They've just been filling in. Sometimes you have CFOs that are also HR, things like that. So then you put on there what your wish list. One of the things you're going to do with this money is hire a person that has XYZ characteristics or experience. And that says to the investors, like, they recognize where they have gaps in their management. And that is a level of strength to be able to realize where you need to add to your team and expand your team and get the right people on the team in order to take it through to this next level of growth that you're planning on doing. And the advisory board fills your gaps. When I'm dealing with startups, I say they don't have money for a management team a lot of times, right?
Yeah.
Or really early stage. But we talked about it last week a little bit, the exec with a check, right? You get somebody that can put money in. They might take a part-time CFO position, CMO position. They're on the advisory board. But I always say, who is on your advisory board that might be somebody that when you raise capital, you're going to bring in as an employee, but they're giving you advice now in anticipation of being able to get through to, being on your team. So all of that shores up whatever weaknesses you are. And then we want to get into the financials. So the financials are, I'm going to let you talk about financials while I take a little swig of my coffee.
All right, well, then this brings up an interesting point that we were talking about. Individual investors tend to invest upon emotion, particularly your smaller investors. Your smaller investors will be like, that looks great, I got to have it. I'm gonna buy it. They like to focus on, anecdotal phrases by, Peter Lynch, people like that, buy what you use, buy what you know, things like that. When you get up the food chain to larger investors, they're gonna invest based upon their due diligence and what they find when they go into your financial model, your business plan. And as a friend of mine who had been a broker for a long time said, money managers and retail brokers, registered investment advisors, they've already separated the investor from their money. Their job is to find someone who can put that money to work where they know they're going to get it back with a return. And that's the difference, okay? When you look at some of these presentations, they might attract the smaller guys that are completely emotional. But when you get up the food chain to your professional money managers and professional advisors, they want to make sure that the money they give comes back so they don't get fired. And then they are they're not driving decent vehicles, and they're not living in nice houses, and they're not enjoying life. They're hating it. So that is where you got to dig down into these details. In my opinion, a financial model needs to contain the key financial statements of your balance sheet, your income statement, your statement of cash flows, and then it needs to contain the various assumptions as to what your costs are and what your revenue is, and then it needs to contain the several schedules that will help you build out your month by month sales forecast, your inventory requirements, your depreciation schedules. Those all get built out, and so that the spreadsheet has to dynamically update. So if you change, for example, if you're building rail car systems that take people from their house down a steep slope to their dock, and I ran a company like that about 10 years ago for a client, and the cost of steel changes. How much does that affect your cost of your installation? Or if your labor goes up, or gas goes up, or diesel, just to get the product there. What does that all entail? That's where you really dig down into the details on the financial model. And the financial model is not just something you show your investors. It becomes a tool that you use to help manage the business. If sales continue to run at this rate, do we at some point run out of cash and need a bank loan because of our balance sheet expanding? And then when you get a big enough business, it's, do you hit your forecast? Are you managing to the model, or where are your shortcomings coming in? And really, when you get up the food chain, to where it's professional money managers, this gets a lot more scrutiny than you would ever think. And I realize that some startups can be hard to model, but I'm of a firm belief you can create a financial model for every business. You just have to understand the business in order to do that.
Yep, absolutely. That the financial model builds upon the business model. So one of the things that I have an adage, and I explain, because your financial. So when sometimes entrepreneurs will, like, you can move this stuff around. So when you're trying to work within a context of a time frame, you might want to move your financial conversation up, and then you go into your partners and your management and that stuff afterwards, right? Because if you don't get to the financial model, what your financial results are, what your forecast is, how you're going to use your funds, then you have missed the very criteria of why an investor cares. How are they going to make their money?
Yeah.
They don't know how much you're asking for, what you're going to do with it, how much you're going to make with it. They can't ever ask that question, right? They can't answer it to themselves. So you're next, and you couldn't tell them the story about why they want to spend more time with you. So some of this stuff that they put in this 10-minute, this is like forever. It's old as the dirt. This chart, this anatomy of pitch is 30 years old. It's still the content of what every pitch has to cover. It's just how you cover it depends on your own story. The really good presentations, their financials are the story. The presentation is the visual depiction of what that story is. The business plan becomes the narrative that explains how it connects all the dots and how it's going to actually work and how it's going to happen. But you've got to really, really understand your financials. What are you going to do with the money? How are you going to make money? That's all tied into who your customers are, what's the size of your market, what your business model is, how you're competing. All of that makes up the numbers. So, and all too often, I think entrepreneurs just sort of think the numbers are sort of okay, let's just, like, here it is, right? And that's really, really where the rubber meets the road. That's the teeth in the deal, right? That you've got to be able to explain the financials, where you're going to go. And it's not an eye chart. It's not like 20 lines of content on there. You want your top line, midline, bottom line, profit. Where does that look? Maybe a bar chart that shows relationships and stuff. If you've got key things, like you're going to announce this new product, you're going to be making this acquisition that's going to bring in revenue of the X amount, you're going to grow this way. All that stuff is highlighted in, if it's a bar chart, that justifies why the numbers are going up. It's not just some percentage calculation. There's actual tangible activity and traction that happens that triggers each of those milestones in growth in revenue. And then the use of funds is all how you're going to get there. The offer is what is it that you're selling in your company to get that money that's going to produce the return based on those financials that is as a result of knowing your business model and your customer and how you're going to generate revenue. It's sort of like you work your story backwards from the financials within the pitch deck.
Oh, yeah. And I mean, the more you understand your business, the easier it is to build your financial model. And when we ran that tram company about 10 years ago, we knew exactly who our customers were. The vast majority of our customers were wealthy individuals who had a house high up on a cliff and had a boat dock that they could not walk down to. We knew who our competition was. We knew the quality of the product out of our competition. We knew what the barriers of entry were, and we knew how to sell to our customers. And when I started with the company, that very first year, most of its online sales were coming from their webpage. Most of their sales were off their webpage and just organic search traffic. Because we understood who our customers were and how they broke down into two key segments. Those who were familiar with the product, so we marketed the features of the product, and those who had a problem they were looking to solve, we marketed the benefits of the product. And so, as you can imagine, we're around about Memorial Day right now, a few days after. That's traditionally the start of boating season in the United States. So a business like that, your heaviest sales are in May and June when people, let me go get the boat. Oh my God, this is a pain in the butt. I just can't do these steps anymore. With our online marketing program that we had started, knowing our customers, we started this around late August. We were having more sales in December than they typically had in May and June. We went into January of that next year with a backlog of sales and products to install that was typically about 30% of an annual year's production. Never had they had a backlog in January before. So the point I bring up of all this, while this is a great story and was a lot of hard work, we knew every aspect of that. We could pitch this in our sleep and answer every question. And we also knew how, as we were thinking about bringing in outside investors, we knew how to condense it down into just over a dozen, 10 to 15 slides. And that is also something we need to talk about. Is how long should your investor presentation be? What are your thoughts on that, Karen?
Well, I mean, as we talked about a little bit at the beginning, the typical, like if you're doing any kind of online pitch event or large conference pitch event, you're going to be looking at a 6-minute presentation.
Yeah.
And in some cases, you might get 9 minutes. If you're going into a boardroom, you really should be prepared for between 6 and 9, but have a lot of backup charts. So one of the things I teach people is when you're going through this presentation, because you want to engage in questions. If you're in any kind of environment where you're able to interact with people, either because it's an online and investors are able to submit questions, or there's a panel that are asking questions, or if you're going because you're one of these that are recruiting some kind of funding, a market maker to take your deal. If we're doing something where it's just like when, people's attention span, or if you're marketing, like what you would describe, you'll have a video that sort of sets the high level, and then you have subsequent stuff that answers questions that they might have, because everybody has a different question. Some investors all care about the marketing, some all care about the patent, some all care about, the cost structure. They have all these different things that are their hot spots. And so you don't be intimidated by a short presentation. You just you say, and if you want to talk about how we have figured out our business model and how we perfected it to have this kind of key performance indicator, we're happy to have that conversation after we finish the presentation. We've got some additional charts that we can review with you, right? And you don't have to go into all the detail. You just tell them that you know the answers and you're going to answer their questions later for whatever it is that they're, because you are prepared, right? So you can hit it at a high level and then move on and then have it as a backup chart, because you may end up being in a meeting in a boardroom for 30, 45 minutes as you're going into, and they're asking all these different kind of questions, but you want to keep their attention in a to the point, concise presentation. And the more time you use for Q&A, even if your if your total time in a pitch event is 10 minutes and you can do a pitch in 5 minutes, that's 5 minutes for Q&A. And if there's something that then they don't pick up on, let's just say they don't pick up on something and they don't ask the question, and you've got some key information in there. Maybe it's the outcomes of a test. Maybe it's I was reviewing a company's, it's a biotech thing. They're doing a WeFunder capital raise, and I was reviewing some of their stuff. They've already done animal testing on this. They have completed animal testing. They have visual shows how it works. And it was so far down in their content where it was like, that has to be up at the top. It's visual. It proves right there that what it does works, right? And you can get to market quickly in the veterinary space because the FDA is going to take longer. And they had it buried. So you've got to always bring to the front the thing that's going to create confidence in your investor audience, that you know what you're doing, what you're selling works, and you know how it's going to go to market. And then you tease that you've got more. So if nobody picked up like on that example, or nobody picks up on that, then you're going to say, hey, I know we covered this really quickly. So since we've got a few more minutes, let me show you the actual outcome of this test, or the actual outcome of this pilot, or what the marketplace looks like if we make this acquisition, or the reason why the trends, whatever that is, you think is a real piece of your secret sauce to success. What is that going to be? So go concise, have backup, have additional comments that you can bring if you end up having more time. That is your, really put the nail in the coffin of closing the deal.
Yeah, and a couple things I'd like to mention. You have to custom tailor these presentations to the investors you're presenting to.
Yes.
Presentation that you show retail investors at an angel group, for example, is going to be different than the presentation you show an investment bank. The investment bank is going to want to know that you got your regulatory house in order, that you've got, advisors or people with deal experience, people that can help shepherd you through the process and make their life easier. And, I got the right counsel that knows what they're doing, and not somebody who has never done this before. So you got to do that. The other thing I'll say is, I've been at plenty of conferences and sat in on presentations, and while enthusiasm is good, and we've all seen guys that are really enthusiastic, the guy that runs late is not appreciated.
Yeah.
When I go to Planet Microcap, you got 30 minutes in a room with a room full of investors. They expect the presentation to be about 15 to 20 tops, or sometimes they're 20-minute blocks, and about half is your presentation, about half is your Q&A. The guy who goes 10 minutes over on the presentation when everybody's wanting to get out of the room to go to the next one to answer the emails and the things that come in for this sort of a crowd, that's a turnoff. Don't go late. Leave them hungry for a little bit more. That's one of the key things there, is just leave them a little bit hungry. If you've got interest, I've got a due diligence room. I've got this. I've got that. Let's talk. Let's get the interest, because what you're going to do is you're going to go back, you're going to meet with them, and you're going to close a deal, get them to sign the subscription agreements and write the checks on a different day.
Yeah.
It's almost never that I'm not giving you a check at this. That's a myth of Silicon Valley.
Yeah. Yeah.
Those are guys that have thrown so much, at the wall, they just got lucky a few stuck.
Yeah. Well, and also part of the, like, as we get ready to wrap up here, want to make sure that people know these are some of this, like some of the things that you're like, what were they thinking, right? Or
Yeah.
like, so first and foremost, you want people to be able to know how to reach you and how to be memorable. You've got to have something that's memorable, because a lot of times when you're filling your capital funnel, you're going to have to do a lot of these presentations, but it's not always the eyeballs that are looking right at it. It's what the eyeballs retain and then share with others at a future date when an opportunity comes up. Oh, looking for a company that does XYZ. Here's a problem. Oh, I saw a company that solves that problem. Well, what's their name? Do you know where it was? If they can't remember you, your company name, or what the context, they can't refer you to other investors. And you've got to have a good, solid word of mouth, something where they can remember you in a way that and on every chart, it needs to have your website or a QR, like a QR code or something that takes them to your link tree that is all your information. Either it's a simple to remember website or a QR code for a link tree that's got book a meeting with you, got your name, got your links, got your calendar, all of that stuff, so they can follow up even if the meeting runs short, they're watching a replay, whatever. It's so critical. You don't even know how often I see presentations and they say their name at the beginning and I'm like, I don't remember that guy's name,
Or
right?
it's like watching a financial channel, like who are they interviewing? Versus, I'd like to point out, right here is my URL. If you want to
Yes.
get a hold of me, you can go to coralcapital.com and find all my contact info.
I need to put that on mine.
Yeah. One of the things I want to point out is, we're talking about this. We're talking about these presentations. I saw a genetic testing company. I've told you this story. I saw the CEO present twice and the CFO present once. The first time the CEO knocked the cover off the ball, one of the best presentations I ever saw in my life. 6 months later, the CFO comes and does it, and I'm like, what is this? This is horrible. It's not it's the same company, but it's not the same presentation. And then the president came back and he totally whiffed it. The same guy changed it up, and there was no excitement. And he was the first guy that I ever saw that talked about how fast you metabolize medicine being a key determination as to the dosage you should have. Because they were talking about a blood thinner for an elderly patient, so you don't fall and bleed out internally because you got too much blood thinner in you. The other thing is, there was a product that came to town. I've told you about this a dozen times. I think it was called XOI. They had found out how to take a pair of Ray-Bans and put the camera right here. Right here. They got a camera right between your eyes. You turn your head. The camera sees what you see. As you move your head, you get this, you get that. They were demonstrating it, for example. Doctors could wear these glasses and have a consulting physician someplace else in the country watch the surgery right with them. I thought about, this would be great for mechanics, this would be great for everything, this would be great for almost anything you could do. And then you see police officers with controversial arrests and shootings, and they got a camera that sits right here or right here, and when that officer turns his head or is running or is scuffling on the ground or something, you see nothing.
Right.
And get bad audio. These guys were set in their way, and the product died. I would have bought that product right there on the spot. They could have sold me a set of those glasses. And they couldn't make it happen. And there are so many great products. Don't let your company be one of those great products that never makes it to market. You got a great idea. Go put it in place. Work with the investors that know what they're doing, the investors that can help you. Know how to get those presentations, and learn how to test your pitch. Who can I pitch this to who doesn't know it that would get excited?
Right. Practice, practice, practice is a big part of it. Being able to deliver confidently in that 6 minutes because you've done it 100 times.
Yeah, And like I say, know your audience. I'm working on a restaurant deal. I think I have found the ideal investment bank for this restaurant. The business plan I'm writing is not the same business plan I'd give a retail investor. You know, what I'm preparing is custom tailored for an investment bank. Answer the questions I know they're going to ask. And you have to do that when you present.
Yeah. Know your audience. Remember why an investor cares, and, convey that message. How you're going to make money, how you're going to make money, so they're going to make money. And the only way you know how you're going to make money is you know all of these things, right? What your cost of goods are, how your cost of sales are, what your sales cycle is, how long does it take to deliver it for you to be able to collect your money? All of that. Money, 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 money. It's all about generating the revenue and increasing profit, reducing expenses, growing the company, and then the rest of it backs up how, verifies or shows evidence that you have the ability to do what you're saying on the financial state.
Yeah, I mean, that's a key thing right there. When I was in the Denver Entrepreneurship Academy, the gentleman, Michael McClurg, who ran it, was an old investment banker from Dillon and Reed, and he said every smart investor knows how they're getting their money back before they write the check. Don't go into a presentation and say, well, we're going to get bought out, pay out the capital, do dividends, go public, do a reverse merger and IPO. Don't list 10 different ways they're getting their money back, because they're not going to believe any one of them is going to come through. Say, our number one goal is this.
Right.
And this is our backup plan if it doesn't work.
Right. That goes into management, knowing how to address whatever uncertainties or unknowns. Anybody doing a presentation right now needs to be addressing all the uncertainties and what is their plan B, their fallback plan in the event, because there's so much. If they don't raise capital in a timely manner, how's that going to work? If they end up having other issues, how does that work? Like if they end up having supply chain issues, how does that work? If they end up having, consumer confidence declines, what happens there? How are they going to grow organically, and manage their expenses? How are they going to utilize tools like AI or blockchain or various types of automation that reduce their costs? They have less labor expense because they've been able to automate things, or they're able to accelerate the delivery of something because they are automating stuff, right? I mean, we were talking earlier today about how I get better at delivering stuff, but then I fill my plate up with other stuff. So it's still like always like stuff to be done, right? We implement automation and it's still, we fill that time. So,
and here's something that's really important. Don't take your presentation to a bunch of yes men. All right, it's good. I call it, I give my business pitches to my wife. If she understands them, I know I'm conveying a good message. If I can get my 13-year-old son to understand these things to a reasonable amount, I know I'm conveying a good message. But then go find someone who's going to be critical. And this is where, go find someone who's got a lot of experience, who's going to say, where are the holes in my presentation? Where am I coming up short? I've seen so many projects where everybody just they look at things. It's the equivalent of your friends are giving you relationship advice by telling you what you want to hear, not what you need to hear.
Yeah.
Is my market survey good or bad? If it goes back to what Dwayne Pearsall said at Columbine Ventures back in the 80s when I was in college, the two most important things are number one is the resume of management. Do you have people on your team that can help get you to where you want to go? And secondly, have you assessed your market? The late great Mark Haynes on CNBC always used to say, yeah, we know people can, but will they? Is it a product that people even want? I mean, not to pick on product, but is it something they're going to pay for? Or that you can deliver? I'm still waiting for Mr. Fusion to power my car. If everybody remembers Back to the Future.
Yeah, so here we are. We're about at time. I just want to say, to Erik's point, and we've given you a lot of great information. We are very experienced, as you can tell, in reviewing presentations, creating presentations that are target the right investors for what you're trying to do. If you've got a presentation that you've been delivering and it's not getting the results that you want, or you're getting ready to have a very important presentation or opportunity to present to a group of investors, it is worth the $1,000, whatever it might be, to review everything, or $500 for just an hour coaching session on your presentation, moving things around, because where you're going to go with that versus the opportunity cost of not having an effective presentation that accomplishes what it is that you're trying to accomplish, and blowing your shot, right? Because you can't come back. It's like a bad interview. You can't come back and say, oh, really, give me another shot. They don't give you another shot. And that word of mouth that I talked about, where you want word of mouth to be able to convey and bring investors in, I have seen it happen the reverse way really bad.
Oh, yeah.
Where companies that don't do a good job, that don't get prepared, the word of mouth on them, particularly in a community like we've seen it here in Atlanta, they can almost never go back and raise capital from those investors again if they've blown it. Now, they can have things that aren't quite there and they are updating and they do the update, but if they blow it, if they blow the understanding their market, if they look like they have no clue as to actually how to get to market, generate revenue, because they're boiling the ocean, they don't understand their competition, they don't understand what their secret sauce is, they don't understand their value proposition, they don't understand how they're going to really generate revenue, they'll never get a second chance, and doors will close on them with future potential investors on that. Now that we know how successful SIG was, now I know that one company, mutual friend of ours, who had pitched to SIG Says No way back when, and the word got around within the angel groups, the angels out there, that he didn't know how to generate revenue. He didn't understand the market, blah, blah, blah. And he never recovered. He was raising capital from all kinds of crazy places because he could never really raise it in Atlanta or New York. So, and he, great technology, still a leader in what it does, still ahead of the market. But the message was so bad because he was an engineer and he was doing all the engineer kind of talk instead of business talk. And investors are business people that understand numbers.
That is true. And I once had a really great engineering client who could not manage a sales force to save his life.
Yeah.
And
that's why the team becomes important to know that you need to hire people for that.
Yeah. And as you can tell, since I don't have a pair of those glasses that I really want, those guys never got their product to market. And they could be multimillionaires many times over now, but they just couldn't get the right part, couldn't get the key parts and put it together.
They were ahead of their time.
Yep. Karen, if anybody wants to reach out to you to get help with their presentation, how's the best way for someone to get a hold of you?
Yeah, so, you can go to my website, cougarrand.com, or Karen Rands, my name, CO. It's the same site. And on the contact page, you can fill that out. You'll get 12 Secrets to Innovation and Wealth, a free ebook and a video series, and a link to my calendar. And you can set up an appointment that way. Or that's probably the easiest way to do that. If you don't want the ebook and get in the email database, well, if you go to my regular Casey, it's bit.ly KYR intro, because those are my initials, KYR capital, intro small. It's got all of the kind of like the highlights and a whole calendar. You can pick it, but 20-minute, meeting, we can set it up. It's free, talk about what you're doing, and then what the next step might be. And if you need a full business plan, investor review, we can arrange that.
All right. And for anybody that needs to get a hold of me, just go to www.coralcapital.com, and there you'll find all our contact information for my staff and myself.
All right. Very good. It's all in the show notes. So till next weekend, let's see, we're skipping next week. right? Because we're both going to be out of town next Tuesday. And
No,
so
I'm
then
out
the
of town
fo-
on Tuesday the 10th. Tuesday the 10th, I'm out
So
of
you're
town.
running next week, and then I'm running the 10th.
Yep. Yep.
Okay.
And I think we'll do one on due diligence next week. We'll do a primer on due diligence.
Okay. That'll be good.
Yep. I'm going to hit stop. We're out of here. So we'll
Onwards and
see everybody.
upwards.
Onwards and upwards. As they said in show business, give them hell.